Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, October the 16th. My name is Eric Wilkinson, and yeah, you might recognize me on mainstream media as the Wolfman. But what I'm here to do is teach you guys not only how to build option strategies and then implement, but more importantly, I should say, then implement those strategies in and around different underlyings where we come up with a directional bias. We don't always know what strategy we're going to use before we have a directional bias. Usually when we're looking at it like the charts on here on crude oil, we come up with our directional bias. Now we need to look in and around all of the environment and all the nitty gritty to figure out what strategy goes around that. And that's what I do with you guys in the market commentaries and in the webinars. All right, but what we usually do is go over the daily economic data. Today we got a bunch of CPI and stuff like that from across the pond and here in the United States. So let's talk about Great Britain CPI. It came in at 1.7%, just missing the 1.8% expectations. Then we got the Great Britain PPI, which is Producer Price Index. That's where the builder or the manufacturer's prices kind of affect the manufacturing process. Usually later on we see that how it affects the consumer in the CPI. So with that being said, we got PPI input, which is the cost of their goods coming into the process. Came in at negative 0.8%, expected to be a positive 0.2%. They also revised last month's number down from negative 0.1% to negative 0.3%. So a big revision to producer price input. That being said, it's going to be much more difficult for them to lay off higher prices to the consumer, all right? So that in and around a time where we're seeing recession, I think that that's a good thing because it allows the consumer to not have to pay higher prices, really, right? I mean, that seems pretty obvious. And then we got core CPI, Consumer Price Index, coming in at 1.7%, which was right in line with expectations. Remember, core CPI is stripping out food, energy, alcohol, things of that, tobacco, things that are a little bit more volatile, especially on the food aspect, not necessarily alcohol so much, but the food, eggs is a big example of price fluctuation in the Consumer Price Index. And then the PPI output came in at negative 0.1%. Expected to be unchanged. Now that shows that those guys aren't really trying to pass off higher prices as their inputs are lower. All right, so that's a good thing across the pond. And then here in the United States, we got our core retail sales coming in at negative 0.1%, expected to be a positive 0.2%. Core retail sales strips out automobiles. So, you know, we would like to see that number, especially as we are not really so far seeing recessionary terms, that we would like to see our retail sales and things of that nature continuing to do good. Now, if we flip back in those automobiles, it came in at negative 0.3%, expected to be a positive 0.2%, or sorry, positive 0.3%, so a pretty big miss there. It's not very helpful. They did revise last month's number up by a couple of tenths of a percent, but not making up for that headline numbers on those retail sales and the core retail sales. It's a bit of a wet blanket if you ask me. Business inventories were moving, so that's good. It was supposed to be a positive 0.3%. They came in unchanged. So it means that those guys are moving inventory despite the fact that we're seeing these retail sales not do so great. And then we saw National Association of Home Builders Index coming in at 71, expected to be 68. So those guys are still pretty confident. Beige book later on today. Now you note that beige book isn't often looked at here in the United States. I think it's one of the major indicators as to what the Fed is going to do because they get something. This is the one that they really look at, but they actually get another one that's revised right before the FOMC meeting. So this one's released a couple weeks ahead of time. We've talked about this before. The FOMC is going to meet on the 30th and come out with their rate decision on the 31st. Those probabilities of a rate cut continue to go down. With the retail sales number and the prospect of rate cuts at this meeting really coming off, it's really not. It's not allowing the equities to get a whole lot of traction to the upside. All right, so let's talk about crude oil. It is unchanged, right in and around where we've talked about it. It wants to stay between 55 and 50, and that's what we're continuing to see. We are starting to see some of the gas prices, at least here in Arizona, start to go down a little bit, albeit only by maybe a nickel or a dime a gallon. But this is what we've been talking about, and we are seeing it continue to trade in and around this area of between $50. $55 right here and $50 down here. So I think that we're going to continue to see that move sideways there unless there's a major catalyst, but I don't see anything on the horizon that's going to be a major mover for that. All right, gold futures starting to climb a little bit today. It's still in a trend channel, which I was expecting us to kind of bunk out of. We need to keep an eye on this low here for that to not have lower lows or lower highs and lower lows continuing on, which we've been seeing here. So quantitative easing, which is the non-quantitative easing that the Fed has been talking about, should cause us to start migrating up a little bit. But with this lack of rate cut being priced in, gold continuing to have trouble gaining any traction right now. Bonds are slightly higher on the day, holding on to that 160 handle. As you can see yesterday, we did break and settle below that. We settled in 159.20, what was it, 159? Probably should be able to figure this math out in my head. 159.27 was the close. Opened up today, and bulls got it back above 160. It's going to be really key to see how we settle out. If we just settled slightly below 160 and maybe even just slightly below yesterday's low there, it would still make this chart look like we found at least a short-term bottom. A lot of people will be talking about these Fibonacci extensions or that psychological level of 160 holding weight, but you know, we need some confirmation here. Market not looking too good, and as Fed Fund futures continue to take out that interest rate cut, we are going to continue to see that market start to slide a little bit. Seeing a little bit of a bump here in the VIX, still in the teens. Like to see it a little bit higher, obviously, as a premium seller. That is because we are seeing the Dow Jones, the equities really come off and really have trouble gaining some traction because of what we saw there in the CPI, the retail sales, not really being a great welcoming bump in our economy. Sorry, son's doing dishes in the background, and it's a little distracting. But here we can see close to unchanged with the Dow Jones. 13 points can be made up in a matter of minutes. But we're seeing the NASDAQ tech is going to suffer a little bit as there is uncertainty. Tech is going to be more volatile. Things are in the NASDAQ because it is highly tech related. You can see NASDAQ down 40 on the day. We tested that value area high. I talked about it yesterday, where we were starting to see some resistance here in the NASDAQ up and around this value area high, touching that, coming close to that 8,000 area. That is where we're going to see some resistance as price starts getting overextended to the upside on that value area high. We're going to see some resistance. We're going to need a nice catalyst to get us up and above outside of that area, because we're going to need that some kind of catalyst to get us up and above those areas to test the all-time highs. But with retail sales, core retail sales not doing so well, that isn't the catalyst we're looking for, right? That is a catalyst that's going to cause us to slough off a little bit more to the downside. And you can see here overnight inventory relatively flat. Tried to get a move higher on the equities off of that bad economic data. I think what the market was trying to say is, hey, this bad economic data is probably going to incentivize the Fed to cut interest rates at the meeting. But then we saw Fed Fund futures kind of scoff at that and continue to come off a little bit, taking away that probability of a Fed cut. And now the market is saying, hey, maybe we need to throw a tantrum at this point to try and wake up the Fed and ensure a rate cut at the meeting at the end of the month. All right, let's talk about the trades that I've done. ULTA, if you guys remember, in ULTA, I only had this trade on since the 10th of the month, and you can see I did it because there was high implied volatility. We were right around the point of control, so I decided, well, if we're around the point of control, that is the magnet, right? The market is going to want to come down to the point of control. Let's we draw it like this. We got a magnet going on, and the market wants to pull in and around this area. Okay, so once we get around those, that's really when we see high implied volatility, a time where the market settles down, volatility comes out, and we're able to take advantage of that. I didn't have a directional assumption with this. There was no earnings, so I didn't have to worry about the earnings because we were in this November area here. So I decided to go in there and do a strangle, right? And I did the November, sold the 210 puts in there and the 275 calls. So I had a lot of wiggle room, 275 calls way up here, 210 almost below where we are on the chart even. The support would probably come in with this tweezer, as you can see there. That usually is a sign of major strength, despite the fact that my Fibonacci is not really... I've got the zero Fibonacci off a little bit. That goes back, that way on a Fibonacci lineup. So we've seen this probably is a real support level that's not being shown on Fibonacci or anywhere else other than the value area low, but that's not really taking into account here. But so we got the high implied volatility. So our IV percent was it was up in the greater than 50. So it was greater than a 50% there. That's a good thing. So I went in there and did the November, like I said, 275 calls and the 210 puts. I collected $2.90 for it. I was able to get out of it for $1.50 this morning. And that is mostly due to the volatility coming out. We went from basically 37% to right now 29%, and we can talk about that all day long. That is great. You almost have 10% drop in volatility, and on a high flyer, something like ULTA with a big price there, that volatility really helped with us on this trade. Not the time. Theta didn't affect us enough. It was all about volatility in this trade, and that is what is super important to take into consideration. I talk about this all the time. It's not about building the strategy. Anybody could have told you how to build a strangle on this strategy. Although I do have rules on the strike location on this, which helped out with the 275s there. And the other thing is, it has to do with implied volatility, and we talk about that in the webinar, so you check those out because that is really what it is about. It's not about building the strategy, it's about implementation, and I can't tell you enough times that that is really the key to success here, and this is a perfect example of that right now. All right, that's all I got for you guys. Check us out on Facebook so you can get access to these daily market commentaries and first access to the webinars. All right, so if you can't take that, take it easy.